This conference will now be recorded.
Okay, so good afternoon and welcome to our 8th weekly webinar. My name is Marty Curtis, and on behalf of all the advisors at Provisions Wealth Planners, I'd like to welcome you to our webinar. Got to tell you, when we started scheduling these webinars 2 months ago, I certainly didn't think we'd still be hosting them from our homes in May, but we're committed to, and we definitely are going to continue these webinars every week until we're back in the office, whenever that is, hopefully shorter versus later. As in recent weeks, we have our guest speaker with us. He'll present about 20 to 25 minutes, something like that, present his thoughts on the current market conditions and economy from PIMCO's perspective, what advisors can expect in the near term, as well as some long-term expectations. We've sent our guests some questions that we've received from clients this week, and he'll address those in his comments. Then after Ken's comments, we'll open the lines for additional questions from the audience. Joining us today is Ken Chambers, Senior Vice President, Fixed Income Strategist for PIMCO. As Senior VP Fixed Income Strategist on the multi-sector fixed income team in the North Beach office, he has responsibility across income, short duration, and enhanced cash strategies. Previously, Ken was a member of PIMCO's client management group focusing on defined contribution clients and platforms. Prior to that, he was a member of PIMCO's global wealth management team in Asia, excluding Japan. Ken has 9 years of investment experience and holds an MBA from the University of Chicago Booth School of Business and an undergraduate degree from the University of Arizona. So Ken, welcome, and thank you so much for joining us today, carving some time out of your day to talk with us and our clients.
Really appreciate it, Marty, and appreciate the opportunity to speak with everyone. In terms of today, I thought I'd make about 20 to 25 minutes of just prepared remarks talking about, the current crisis, how did we get here, what has transpired, and a little bit of at least PIMCO's thoughts on where we're going. But then also talk a little bit about markets and how different technicals and valuations are being impacted in today's market, to just give you a general sense of what we're seeing on the desk. And then we'll open it up for some questions. But if you think about the current crisis that coronavirus has really presented, not only the U.S. but really the global economy, first and foremost, this is a humanitarian crisis. This is something that we often are focused on: markets, asset prices, stock markets, bond markets, things like that. But at the end of the day, there is a humanitarian component to this that I think we're all focused on as it relates to just protecting not only ourselves, but our families. And I really don't think that can go understated, because it does have implications for the markets, for different economies around the world. As we take a pause, see where we're at today, obviously this idea of reopening is something that is not only needed to an extent to help generate growth in the U.S. and globally, but I think just generally it's really the focus at this point in terms of how quickly can we start to go about a not necessarily back to our old lives, but this new normal life, knowing that there is this uncertainty around the coronavirus at this time. If you look at the crisis in terms of how it's impacted markets, it was swift, extremely fast. It really hit the U.S. and most developed markets at the end of February, early March. Obviously, coronavirus really started in Wuhan around the end of the year, early January, and containment measures, for all intents and purposes of what we currently know, did fairly well in terms of limiting the number of deaths and really allowing that economy to start to come back online most recently, and that's actually helping overall growth. However, what transpired in other developed markets, notably things in Europe and here in the U.S., major economies from a global scale, and now it's starting to make its way into many of the larger emerging markets, things like Brazil, India. It is certainly not only tragic from a humanitarian side, but from an economic standpoint, and you can see this from just manufacturing numbers, you're seeing massive declines in terms of just economic activity. So the broad-based containment measures that were taken really in the middle of March on a global scale are certainly seem to be working. However, the reopening continues to be what is most focused on by a lot of not only policymakers, but I think everyone that's sitting around sheltering in place to say, how long is this really going to go on for? How this impacted economies, you should think about it in a couple of days or a couple of ways. It just classic econ supply and demand. This is not only a demand shock, so people are out there not going to the same restaurants, we're not buying as many goods, but there's also a supply component to this where corporations are being forced to close certain plants and not being able to supply as much. So it's trying to find this equilibrium and this balance. But I think the biggest thing, especially for the U.S. economy today, an economy that is primarily driven by consumption, that's really why you're seeing not only the Q1 number be relatively poor as it relates to overall GDP or growth, but anticipation for not only Q2, but the third quarter of this year to likely have negative implications. But in general, you are seeing a severe contraction that's gonna impact growth both in the short run and potentially the long run. When we talk about the speed of the crisis, I think it's important to put into context relative to other recessionary and crisis periods, and there are a lot of parallels to 2008, specifically around the policy response by the Federal Reserve, some of the policy response by the current Congress and Trump administration. But the speed at the crisis, the fact that coronavirus impacted equity markets in a matter of 3 to 4 weeks is really severe. And if you compare that to 2008, that crisis actually took about 13 months. So all risk assets, all markets, fixed income, equities, really took it on the chin during the month of February and March. And you've seen, I would say, a really significant rally in risk assets. And when I say risk assets, I'm talking about equities, as well as some credit sensitive assets, corporate bonds, things that we would buy on the fixed income side of the ledger. And, the recovery is not all the way back, but it's been certainly fueled by the policy response by both the Fed as well as the current administration. So there's been a little bit of a tailwind, at least for fixed income, because you're going to be earning your yield, earning your interest payments along the way to help offset some of those declines that you might have experienced. But on the equity side, that's where a lot of analysts, a lot of folks have been looking through the current numbers and saying, okay, the Federal Reserve, the current administration, Congress, they're going to be able to build a bridge for the economy to float across. And once a vaccine is developed, once proper testing is developed, we'll be able to get through on the other side. And I think that's where you really start to see people move to different sides to say, okay, that's the right approach. It's going to work. And then some people are saying, we have no idea how long this will last. We don't know what type of measures you're going to have to see the administration, what type of measures the Fed will have to do on an ongoing basis. And there's certainly going to be some bankruptcies along the way. And then there's been other factors, specifically the energy markets. You've seen oil trade significantly below where it has been in the past because of some of the pressures that you've seen from OPEC and Russia type nations that are really impacting different sectors of the economy. So already a situation where economy or sectors or companies are stretched, and then you have other idiosyncratic factors that are really going to potentially accelerate bankruptcies. I want to talk a little bit about the policy response because it has been swift, just like the drawdown, but it's also been, I would say, robust in the types of measures that the Fed has taken place. So they have announced, I believe it is now 12 different facilities, each targeting different sectors of the economy or different sectors of the market to help, again, shore up at least things on the front end and help liquidity be eased or financial conditions be eased for certain corporations to, again, help make sure that they're able to get through this relatively challenging time. These facilities, if you watch CNBC or even some of the broader news publications, you're going to hear a bunch of acronyms thrown around. There's the CPFF, which is the Commercial Paper Funding Facility. PIMCO's actually was tapped by the Fed to run that, similar to what we did in 2008. You have the Money Market Liquidity Facility, MMLF. You have the Secondary Corporate Bond Facility, SMC. So it just goes on and on and on. But each one of these facilities, you should think of it almost like circuit breakers in the system. Or if you know, I live in California, we unfortunately have wildfires, it seems like every year, and we'll send our firefighters out, and they're not necessarily fighting the blaze, they're more cutting breaks to make sure that the fire doesn't jump from one place to the next. That's what some of these facilities are designed to do, to make sure that, one, you contain the damage, and then you can really start to hone in and zero in on certain segments. So what has been supported has been money markets to ensure that you don't have essentially a run on the bank or run on the money markets as everyone tries to exit all at the same time. You've seen commercial paper, so how many corporations, large corporations, fund themselves. They now have access to these liquidity facilities to ensure that they can make payroll, things like that. You're also seeing corporate bonds and potentially corporate bond ETFs be bought by the first time by the Federal Reserve. And then there's other types of liquidity for asset-backed securities. So really things that are designed to generate liquidity to improve those financial conditions, which has aided the recovery in many of the fixed income as well as many of the equity asset classes, just because they kind of build upon that overall theme. That's on the Federal Reserve side. So I'd say there's three things that are most important in terms of understanding or driving today's markets. First has been the Federal Reserve response, or central banks just broadly. ECB, Bank of Japan, Bank of Canada, everyone has gone into accommodative, let's do what we can to help the economy at this stage. The second one that everyone is focused on has been the response by the government in terms of fiscal policy. In PIMCO, for quite some time, we've talked about this idea that there's only so much that monetary policy can do, only so much that the Fed lowering rates, targeting some of these asset purchases. What is certainly needed is a fiscal response. And you have certainly gotten that 4 times so far. And they're already continuing to talk about additional easing, additional measures. These are things like the payment protection program that's designed to specifically help small businesses and ensure that people stay on payroll and will hopefully have a job once economies around the country reopen. You also have different types of stimulus bills to help with testing, to help fund hospitals. All of this stuff is what we call fiscal policy. That's obviously the government stepping up to the plate, coming to an agreement and aiding different portions of the economy. So both monetary and fiscal policy, very fast, very robust, and very targeted to make sure that we are building that bridge to get to the other side. The third thing that everyone is focused on, and this is really what's going to dictate the shape of the recovery. If you watch CNBC, you watch anyone talk about what things are going to look like 6, 12 months, everyone's going to talk about, well, the recovery is going to be a V shape, meaning we had this really significant detraction and then everything's going to come back online. Or it's going to be a U shape, this idea that you're going to go down, we might muddle along for a little bit, but once a vaccine, once testing is in place, we're going to go ahead and catch an upswing in the shape of a U. All of these things are trying to understand what growth will look like. And that is so important because obviously growth leads to economic, or it means that you're having economic activity, and there you're going to have more employment, wages are going to go up. And then again, in an economy like the US, where a vast majority of it, close to 75%, if not more, is driven by consumption, that's really what will stave off any type of crisis. So PIMCO, we are in the U camp. What is really going to be a huge determinant upon that U is going to be the stages of reopening. The idea that it's going to be very regional specific. And I sit in California. We've got an office in Texas and we have an office in New York City. I will bet a lot of money that I will be able to go back to my office before my colleagues in New York will be able to go back to their office. And it's these types of things that you're just going to have regions open up at different times in different ways. And hopefully things go as planned and we don't have a flare up, because that would obviously be a setback. A setback would be a negative scenario. You would see that really stress most likely on the equity side of the market. Fixed income, because of what the Fed has done, again, those circuit breakers are in place today to make it so that there might be a little bit of volatility, but not to the same degree that we saw during the month of March. So ultimately, if things go well, you will see a U. I would say one of the biggest things that we are focused on as a guidepost to help us understand what shape that U is going to look like has been or will continue to be small and medium-sized businesses. Those businesses account for about half of the labor force. These are all the businesses that are essentially were able to obtain financing or loans through that PPP program. So they're responsible for about half the labor market. They're responsible for about 40 to 45% of GDP in terms of consumption. So that's that segment of the market that certainly is under stress conditions today. And if you were to have coronavirus be more prolonged, reopening be delayed across the country in different states, that's going to be a really large headwind that if you're allocating assets the way that we do from a fiduciary capacity, an asset allocation perspective, you just need to go in eyes wide open to say, okay, valuations might look attractive, but there's maybe a reason why they do. Or there's certain asset classes that might look overvalued given the run or the rally that we've seen over the last 3 or 4 weeks. Do I want to have that type of risk or volatility profile? And I think as an active manager, PIMCO is an active manager, we're constantly trimming and hedging different positions, because while we have a base case, we have our what we believe will be the most likely outcome, but our crystal ball is not necessarily better than anybody else's. So you want to prepare yourself and your portfolio for different states of the world. A couple of final comments, and then we're going to open it up, I think, for questions. One of the things that PIMCO really developed after the 2008 crisis in terms of trying to understand the policy impacts and then how that subsequently impacts markets has been this framework of what we call the concentric circles. So if you think of what concentric circles look like, you have one circle in the middle and it goes further out, further out, further out, just a bunch of circles going off, almost as if you threw a stone into a lake that was flat. In the most center part of that circle, you have essentially the highest liquidity asset classes. Those are things like treasury bills, repo, things that are utilized by money markets. Those are the segments that the Fed is going to be buying first to boost up the economy, and then it's going to go to the next ring. That next ring was often 1-year treasury notes, 2-year treasury notes, very short-dated commercial paper. You keep going further and further out, making sure that you provide enough stimulus, provide enough of a safety net, and what that does, it brings those prices higher and those yields, if you're a fixed income investor, lower. A lower yield, higher price makes it look relatively less attractive for us as a manager trying to add value to an extent. So you start to essentially push people out of different markets, and by doing that, you create better liquidity in all these other markets. That's really what the Fed is focused on at this time, and I think just how this downswing was so fast, that the recovery has been relatively quick so far. There's still a significant room to go from here. So while maybe equities and some risk assets have done well over the last 3 to 4 weeks, I think at the end of the day, the uncertainty around the coronavirus and the implications for that that's a material overhang that you have to take into account whenever you're deploying assets. A little bit about what we were doing in March. What ended up happening is you had what, for all intents and purposes, a little bit there, you had somewhat of a bank run where many investors were trying to pull their assets out as quickly as they could. And what that does is it really puts a stress on markets and managers to raise liquidity. When we say raise liquidity, they need to, in a mutual fund or an ETF, you have to sell securities to be able to create the dollars that you're going to pay back to investors. And just like in a bank run, if everyone's trying to do it all at the same time, there's only so much that people can walk through that door at the same time. And that's why you had this huge price dislocation, these huge shocks to the market. So as an asset manager, we always focus on being prudent and making sure that we have proper amounts of liquidity to meet those types of redemptions. But that volatility turns into an asset manager's dream to an extent. You can really do your fundamental bottom-up credit research and say, all right, Disney, Google, Apple, these companies that essentially print money, are they going out of business? Are they going to be able to make their coupon payments or their interest payments over the next 2, 3, 4 years? Those are things that we can do and we can model out. And again, we can provide liquidity. We can buy those types of attractive securities during those risk off time. We also think about it in terms of different types of asset classes, and then also of what type of support is going to be provided by the Federal Reserve. Because now that you have the Fed back in the game buying different asset classes, that again provides this appetite of liquidity that's going to come into the market, and it's going to be relatively supportive. Valuations matter. So what I just talked about was the fundamentals. Fundamentals matter. Do corporations have the ability to generate cash flows? Do they have the ability to withstand and be able to generate cash flows over the short term and the long term? Those are things that we can do to analyze. Then valuations come into play, and that's where you look at, well, do I want to own this company or that company? Do I want to own high yield bonds, or do I want to own investment grade credit bonds, or maybe I want to own muni bonds? These are the things that we will look at of how one bond is trading to another, and we will look at relative value, what looks cheap compared to historical norms for those specific asset classes. When I say investment grade or high yield, how are we looking compared to more normal states of the world? But then also in building a portfolio where we're making allocations, we'll think about, it might look more attractive to buy investment grade credit today than it would be to own high yield for XYZ type of reasons. So those are all things that valuations during that crisis period got very, very cheap, i.e. very attractive for us. And that's where doing that bottom-up fundamental research certainly helped in terms of us adding proper amounts of risk, but not going full tilt owning everything under the sun. If we think about one specific sector, and this was one of the questions that was posed, just this idea of what's going on in the energy sector, that there are certainly really big knock-on effects of what happened during March and early April in terms of OPEC Plus essentially adding a ton of supply when the market price was already somewhat depressed. You saw volatility around oil prices really pick up. Most dramatically was really 2 weeks ago when you saw WTI, West Texas crude, from a delivery standpoint, a futures contract, go negative. For all intents and purposes, oil is obviously a commodity that is utilized. Most people think of Brent crude, which is international oil. Those are the prices that most people will quote. But from a technical component, WTI is U.S. oil in Texas, and that oil actually gets delivered. So if you are playing in that oil market, if you're playing these oil futures and you're long and you own an oil future in WTI, you better have a place to store that, because it's coming to you in the month of May. And that's really what caused such a decline in the price of it, because everyone started looking around, and it's like, I don't have anywhere to store this oil. We already have too much supply on hand, and that's what drove that technical move in terms of the oil price. But I think that underpins, and that example just underpins the stress of that sector specifically. You've already seen a couple of companies go out of business, unfortunately, because they are more shale oriented, they're more drilling oriented, and require oil to be above $30 or $40 per barrel. There are certain, depending upon your efficiency in getting oil out of the ground and to the port or wherever it needs to go, there's a price that there's a break-even price that matters there. And with prices in the $20 to $30 range, that really puts a lot of pressure on a lot of existing operators really at this time. So our view on this is that you are likely to see some bankruptcies. You're likely to see some fallout from this. But at the end of the day, you got to be able to model these things. You have to be able to try to figure out who's the right one to own and who's the wrong one to own, and make sure from an active management standpoint, you go ahead and do that. A lot of these oil names are in the high yield sector. So whenever you're making a high yield investment, the idea of bankruptcy, you have to take that as one of the potential risks. So that should be reflected in the return that you're going to be earning. The other thing that's happened within credit markets is entering this crisis period, investment grade companies, the lowest tranche is BBB. That tranche has been growing, or that amount of companies that are BBB rated has been growing significantly to the point that it's close to 50% of the overall investment grade credit universe. And as you've already seen a couple of corporations get downgraded from investment grade to high yield, that has implications. Passive managers are going to be forced to sell. A lot of institutional managers and people that we manage money for, they have in their policy statements, you can't own anything that's high yield rated. That would force us to sell. There are just technical components that happen as there's rebalancing. And for all intents and purposes, the investment grade credit market is significantly larger, multiples of the size of the high yield market. And if you're to have a bunch of these bonds get downgraded, it's just going to create a lot of indigestion in the system, potential for volatility. Again, volatility from an active manager perspective, that creates a lot of opportunity, but you have to do your bottom-up homework to make sure that you're doing the right thing. One of the things that we do specifically at PIMCO is we have our independent credit research team. It's about 65 analysts. They cover sectors and they cover investment grade and high yield. So as bonds migrate down or move up, a rising star is what we call those. Being able to identify those things and the industry trends, we feel like is really, really important. And really over the next 6, 12, 18, 24 months, as economies evolve, as hopefully clarity on coronavirus develops, you're going to see, hopefully the cream rise to the crop as it relates to picking the right credits and avoiding those ones that, no matter what the support by the Federal Reserve, you can't overcome everything, and that's where you're likely to see some type of bankruptcies. The last comment I'll make is really around yields today. The fact that the Federal Reserve is back at the lower bound and zero interest rate policy. Where do we go? What do we do from there? Well, remember the policy rate is the first thing often that the Federal Reserve will do to stimulate growth, stimulate the economy by lowering interest rates, with the hopes that everyone goes out and buys a car, buys a house, finances things to increase economic activity. There's not a lot of great examples of economies getting off the lower bound. I would say the U.S. was one of those, but obviously we're back here today, and that is to an extent somewhat of the proper response. And then you think about the other facilities that are being out there. So what does that look like? Well, it's a little bit of going back to the playbook of 2009, 2010, 2011. It wasn't until 2015 that the Federal Reserve started raising rates. So you think about owning a proper amount of risk assets, equities, high yield, investment grade credit, pairing them properly with core bond funds, municipal securities, short duration type of exposures, to make sure that you're consistent with whatever your objectives are. There are certainly going to be segments of the market that are supported, but I think distinctly different, and I've already hit on this a little bit, of this go around compared to 2008, 2009, you're likely to see more bankruptcies and actual companies going under. You certainly had a few really well-known financial companies go out of business in 2008, 2009. This time, the banks are in really, really good standing. The regulators went and cleaned up a lot of those balance sheets back in following the 2008 crisis. Now it's much more of those companies in the real economy that are potentially going to have to go out of business. So what you do from a fixed income perspective, you think about building a diversified portfolio. You really think about doing your bottom-up credit research and finding the right value, and really pairing it with high quality assets with your risk assets to make sure that you're able to meet whatever that objective is, fully understanding that, and you continue to hear this from the Federal Reserve, whether it's Chairman Powell or Fed Vice Chair Rich Clarida, the Fed is going to continue to do whatever it takes to ensure that we get to the other side. So from our perspective, knowing that the Fed's in the game, they're going to be this passive buyer. There are certain tactics that we can do from a structural perspective to generate yield, to generate returns. But overall, it can't go unstated. We're facing a humanitarian issue and the coronavirus, which to an extent, until we have a vaccine, until we have proper testing, there are going to be slow starts in terms of this reopening. So there's going to be overhangs. And hopefully, in a couple months, Marty, you're not continuing to do these from your home office. But I think at the end of the day, the coronavirus is really going to dictate that reopening stage. I'll stop there with the prepared remarks and let's see what questions we can answer.
Okay, thanks, Ken. We've got a couple. So the majority of the people on the call are from Wisconsin, in Packer country. And so as of late, we've had several meat packaging plants that have impacted, number one, the meat supply and all that kind of stuff. And a lot of cases are showing up. And so where, you've got New York that are, the number of cases are coming down. We're going up and going up significantly. We just talked prior to you jumping on the call that, one of our clients, there is now 3 families within a stone's throw of his house that have been, confirmed with the virus. So it's kind of getting real for us. More so, we've been hunkered down now for a couple months, but it's hit home. It's really starting to hit home for us. So some of the questions are, this whole meat packaging plant and the supply issue of meat. Can you address that for us?
I think, again, at a first start, this is really why this is more of a humanitarian component, and then there will be effects or implications on different economies and markets. The idea or the fact that what you just described of you're starting to have those increase in cases is a scary thing. And you think about what's going to be the stop to this. I think the nice thing is where there is some light, it feels like at the end of the tunnel, is this idea of, you look at New York, you look at other metropolitan cities, the shelter in place, the containment measures seem to be doing their job. However, that doesn't stop the fact that you need to have proper testing in place to make sure that we're all aware and understanding who has the virus, who doesn't, who needs to shelter in place a little bit longer. And then it's going to have those implications on companies, corporations. And that corporation could be a meatpacking supplier. That corporation could be, a Culver's or something like that. That's going to cause that one to close. And that's where you have to do the proper steps. You have to do the proper cleaning. And while it could create an imbalance in the short run, right? You're not going to have enough. You'll have less supply of goods, less supply of meat. That doesn't change the demand side of the equation. So if you go back to Econ 101, if you have less supply and the same level of demand, you're going to see prices go up, unfortunately, and people are going to have to find different alternatives to from a food perspective, which this is the scary thing, that you hope that people can have cooler heads and not try to just completely pack their freezers and make sure that there's enough for everyone. But at the end of the day, this is that supply and demand equilibrium that will need to be established over this short period to hopefully get us to a longer term perspective of, plants are opening up in the right proper cases. And this is why that reopening process is going to be very regional specific, because the virus is going to be impacting different parts of this country, similar to how it's impacted different parts of the world at different stages. But you really cannot rush to reopen. And my comment about even myself going back to our office, I can't foresee going back until there's proper testing to be sure that I'm not going to bring anything home to my family. Same goes for my colleagues in New York and really all throughout the country. So that is where this is, remember, a humanitarian effort at the beginning, and reopening is important to make sure that corporations are back and we can all do everything similar to what we did before, but it's going to be lumpy, it's going to be in stages, and hopefully not one of these things of reopening back to containment, reopening back to containment. That'll be where the proof is in the pudding.
Okay, thank you. We've also had several questions actually about, bonds have been beaten up over the last couple of years. We're at, in essence, a zero interest rate environment. Where do we go from here? Where do we look within the fixed income markets on behalf of our clients?
So there are segments of the I think that's where you can't just classify all bonds as the same, because there are going to be bonds that are tied to corporations. There's going to be bonds that are tied to what we call securitized assets, things like underlying mortgages, loans for autos, loans for student loans, credit cards, things that have different underlying drivers to that overall return. But then you're obviously going to have bonds by the U.S. government. And when you see a 10-year yield in the 60 to 70 basis points, so barely more than 0.5%, there's not going to be a lot of excitement around that idea of a value proposition. But that's where it really comes back to a proper asset allocation, pairing fixed income with your risk assets like equity. And the reason why you want to do that is because exactly what you would have just experienced during the month of March. As your equities were declining, the S&P was down 30, 35%, core fixed income was actually positive. So you need to have something in your portfolio when your equities are zigging, you got to have something that zags. And that is really the role of fixed income. What we do as a fixed income manager, we're going to obviously target certain levels of what we call duration, interest rate sensitivity, making sure that, as rates go down, your bond prices go up. But then we're going to look to other portions of the market, corporate bonds, both investment grade, high yield, securitized assets, things that are going to be able to generate a little bit of yield, a little bit of return. But you're exactly right. The move that we've seen by the Fed and just generally in the market, bringing rates lower, that is bringing more or less returns lower for all, not only fixed income assets, but also equity assets on a go-forward basis. That's why at the end of the day, we really do think that you need to, one, make sure that you have proper allocations between different risk assets, but then even two, looking under the hood and saying, okay, this type of fixed income portfolio that's balancing yield, that's balancing income, and thinking about different sectors to help generate returns might be better than just going and buying a passive core bond fund, because that's just the cheapest and easiest thing to do. Forward looking, because rates are going to be moving around more so because of the challenges that you're having within corporate bonds and the fact that you're going to have a significant amount, most likely a significant amount of downgrades. That idea of picking winners, avoiding losers is going to matter even more on a forward-looking basis than it has over the last 3 to 5 years.
Okay. Okay. Diversification is the name of the game, again.
Yeah.
Yeah, okay. Great, so I think that covers all the questions that have been posed prior to the call. So I'd like to open it up to the audience. If there's anybody that has joined us today that has a question for Ken, now's your chance. Yeah, Ken, and as I expect, this is when we have a large group on here and things tend to go radio silent when when I ask for that. So so we'll move on, and I really want to thank you. It's always great having the insight of somebody with your expertise join us for our calls, and the feedback that we get from our clients has just been great. So thank you so much. And thank you for everybody else who have joined us on the call. And we look forward to you joining us for next week's webinar when we'll feature the thoughts and insights from Greg Lucan. He's representing Lucan Investment Analytics. The webinar will again be on Wednesday at 3 o'clock. That's May 15th. And as always, we appreciate the trust and confidence that you place in us as your financial advisor, and know that we continue to work hard every day on your behalf. If you have any other questions, please reach out to your advisor. Any comments or questions whatsoever, let us know. And with that, everyone stay well and appreciate you attending, and we'll talk to you next week. Thank you.